Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.
Welcome, everyone, to the Spin Life Well Show, a podcast where we just explore biblical wisdom and how that applies to your financial life. I'm Certified Kingdom Advisor Mark Trice. In the studio today with me is fellow financial advisor Jesse Hamilton.
Hey, Mark, and everybody, welcome to the show.
So this week, Jesse, I wanted to talk about something about giving. And really, how do you make a tax-free donation from your IRA account?
So this is something Mark and I are very passionate about. We love to help people give more than they do and just be completely generous with what they have, what they've saved up for retirement. A lot of people think that their IRA or their 401k is kind of their nest egg, which it probably is, but it's also a good place to give from.
Yeah.
If you're old enough.
And so you may be able to make tax-free donations this year of up to $105,000 from your IRAs. But you need to follow certain rules. In today's podcast, we're going to go over those rules and talk about how to make those gifts from your IRA tax-free.
And the lucky listener will have updated code. This information was written as early as a month ago, so it's all updated.
So these types of gifts from IRAs are really called qualified charitable distributions, or QCDs for short. But the strategy only works if the rules are followed. The first rule, Jesse, is you have to be at least 70 and a half when the distribution's made. Now, this is real important.
This is as simple as 6 months after you turn 70. Don't do it too early, though, because if you do it even a day too soon, you could be disqualified. You will be disqualified.
Exactly, and you'll end up paying tax on all that when you didn't think you were going to have to. The second rule, Jesse, is about ensuring that the distributing account is actually eligible for a qualified account.
Exactly. So it has to be an IRA. It can be a traditional IRA, a Roth IRA. This also includes SEP IRAs and simple IRAs, which you may have if you are self-employed or work for a small business or something. But our main point, I think, is that QCDs cannot come from an employer-sponsored plan like a 403B, a big employer,
right?
457 or 401k. So this is a really good reason to move it.
You can still do it, but you would have to roll it over to an outside IRA versus the plan. So, but, and Jesse, one of the things we mentioned earlier, that the maximum amount that you can do to a QCD or qualified charitable distribution is $105,000, but that's per person.
Yeah, so if you're a married couple, you could move it up to $210,000 and say that you've been really aggressively saving and you have a really large IRA. That might be potential there.
Right. So you want to make sure, though, that the max per person for each spouse is 105 total. So total for that individual, 210 for the couple. Right. So the next rule is you can offset deductible traditional IRA contributions. Now, the Secure Act 1.0, which I forget which year it is because there's 2.0 and everything else, the Secure Act 1.0 removed the age limitations for making contributions to traditional IRAs. As a result, you can make a traditional IRA contribution while taking a qualified charitable distribution. If you make deductible traditional IRA contributions for the year you reach 70.5 or later, the non-taxable portion of your QCD is reduced by the deductible balance from these IRA contributions. Now,
I'm kind of jumbled there, Mark.
Yeah. So I'm sure our listeners, their heads are swimming and so forth. So let's look at this. Let's take an example of Carla, who attained age 70.5 in 2021. She made the following deductible IRA contributions.
So she's adding this money to her IRA.
She's adding money to her IRA. She made a contribution in 22 of $5,000, and in 23 she made a contribution of $5,000. And then this year in 2024, she hadn't made any. Her total deductible traditional IRA contribution over those few years was $10,000.
Okay, that makes sense.
So Carla wants to make a qualified charitable distribution of the following amounts.
Mm-hmm.
She wanted to do $6,000 in 2023. We're assuming that she has already reached 70.5. So those QCDs can usually be excluded from income. Now, this entire amount was included in her 2023 income because it was offset by the $10,000 of the deductible IRA contribution she made once she reached 70.5. So she has a $4,000 of deductible IRA contributions left. So in this scenario, $6,500 for 2024, $4,000 of that is included in Carla's income, and $2,500 is excluded from her income with that. So yes, there still was some tax benefit for doing that, but you have to be careful if you're making traditional deductible IRA contributions that can't, after age 70.5, that can complicate the rule.
So basically, if you are wanting to give in this way and you're still contributing to it, you need to think about the ins and the outs.
Consult a tax professional.
Right.
Or give us a call. We'll help you walk through it, but you still want to have your CPA check it out before you do that. So the fifth rule here is the pro rata rule does not apply. I know we're getting a little bit in the weeds here, but if you have basis or after-tax amounts in any traditional IRA, SEP IRA, simple IRA, distributions from any of your IRAs will include a prorated amount of pre-tax and after-tax amounts, unless an exception applies. Now, the qualified charitable distributions are an exception to this pro rata rule. So you wouldn't be subject to the taxes on that's for the after-tax amount, okay, or the pre-tax amount. So for Roth IRAs, earnings are usually distributed last if your Roth IRA is non-qualified, but with QCDs, your earnings are distributed first, making the earnings non-taxable. This is a little bit more complicated here, so I want to go ahead and jump into the sixth rule, Jesse. What's that?
Okay. Make sure the check is made payable to an eligible charity. So a QCD must be made directly from your IRA, payable to the qualified charitable organization. This can be your church or your favorite mission group, maybe a charity, local charity that helps people. The check needs to be written out to that organization.
The point, Jesse, is that money should never touch your hot little hands.
Yeah, if it's ever made out to you, you're going to pay tax on it.
Right. So if you have your IRA custodian send that check directly to that church or charity, it will not be subject to the tax as long as it's a 501(c) type charity.
So just to be clear, if you are above 70.5 and you take money from an IRA and then give it anywhere, you need to rethink the way you're doing it.
Exactly. We see people doing this all the time. It's like, well, wouldn't you like to keep more money in your pocket? Well, sure.
Or give 10, 20% more.
Or give more. So make sure that that check goes directly to the charity or church. One thing you might want to consider, though, when it's sent from your IRA custodian, they don't put it for who it's from. It basically just says, this made out to church and it's this amount. You can ask your custodian to put in the memo line, hey, this is, Jesse Hamilton that's making this gift. You don't get credit for it at that charity or anything like that because you can't take the deduction. But at least they'll know, hey, this gift came from Jesse.
Right. So seventh part here, no tax withholding applies. You want to make sure that 0% tax is withheld. And I went ahead and moved on because I actually processed one of these yesterday, Mark. Yeah. And the memo line, sure enough, said the couple's name. And then we checked 0% tax withheld. And the check was made out directly to their church. And it was as simple as that. They never saw the money and the church got paid.
That's right. And so, no tax withholding applies here. This is the seventh rule that we're talking about today. When you request a QCD, you're considered to request a distribution with zero withholding tax. And so that amount of money, Jesse, like you said in your example, will be given directly to that particular charity.
Yep.
Let's talk a little bit about RMDs because I think this is real important.
So RMD is required minimum distribution, which is now age 73. If you are of that age, you know that you have to take a certain portion of those funds out. You're required to take it as income. But something really cool that we get to work with people on is that these qualified distributions they contribute towards the RMD.
They count towards it. So here's an example. Let's take 75-year-old Johnny. Johnny's got an RMD from his traditional IRA, and that amount this year is $10,000. But Johnny wants to make a qualified charitable distribution directly to his church. Well, that $10,000 that he wants to give will satisfy his entire RMD. So if you make a gift and you say you've got $10,000, you have to get out of your IRA for RMDs. If you make that as a qualified charitable distribution, that will be your RMD will be covered by that gift that you made.
Right. And say he's in a 12% tax bracket, he just saved $1,200.
So the big catch here is that Johnny needs to do the qualified charitable distribution before any other distribution. So let's just say that his RMD was $20,000, but he only wanted to give $10,000 to his favorite charity. He has to do the qualified charitable distribution. I mean, that money has to come out of his account first, then he can satisfy the remaining part of his RMD. So if you're taking monthly withdrawals, this is not going to work for you necessarily. So make sure you're coordinating with your financial advisor or tax planner to help you understand the rules so that we don't have any little gotchas, okay? Now, here's another example of a point that I'll make sure of here. When you have a required minimum distribution, you can't roll it over anywhere. It has to come out. Now, you can put it in a taxable account and things like that, but you cannot roll it over to a different IRA. Or what's our ninth rule to follow here, Jesse?
So make sure that these QCDs are cleared from the IRA by year end. So this means if it's December 30th and you haven't started yet, you're probably going to miss it. We recommend as early as October to do this. Make sure that you have plenty of time for the custodian to make that check and send it off.
Because the thing here is it has to be cashed. And so by the end of the year, if it's not, then it's not going to count for you. And then our final rule, Jesse, let's jump in here. The taxpayer must report this gift as non-taxable. And now you may be thinking, the listener may be thinking, oh gosh, well, I thought that was the whole point. It's not taxable. Well, here's what happens. In January or February the following year, you get a 1099-R from your custodian that says you took out, and we'll go back to Johnny up here in that example, you took out $10,000 and you withheld no tax. And so if you're doing your own taxes or you forgot to tell your CPA or tax preparer, it's going to act like you owe money on that $10,000, the tax programs. So you have to make sure that you tell your tax preparer or that you check the right box in your TurboTax or whatever you're using to do your taxes that was a qualified charitable distribution.
And of course, if you are doing this kind of movement and you're in retirement, we definitely recommend to use a tax professional because they're going to be able to mark on your tax return that this was a QCD.
And some people, our clients, we send them a letter at the end of the year in January or February the following year that says, hey, here's our record of what qualified charitable distributions you made this year. Make sure you give this to your CPA along with your 1099-R. Mm-hmm. But a lot of times if you don't, we've had clients call us up and they're like, I owe $5,000 in taxes. And we look at their return and we realize that they didn't tell their CPA that they took a qualified charitable distribution. And therefore, once that was fixed, they ended up maybe getting a little money back. So anyway, lots of complex rules. We encourage you to talk to your advisor. If you don't have an advisor, you can give us a call, 254-282-0495. That's 254-282-095. And always you can text us or call us on that number, but you can also send us an email at info@clearvistafinancial.com. Want to hear more podcasts or maybe see some of our videos that we have on educational topics? Visit our website at clearvistafinancial.com. That's clearvistafinancial.com. Jesse, I think this has been a very informative podcast.
Yeah, I know it was kind of some heavy tax information. We would love to talk to you about this. This is something that Mark and I are passionate about. If you have questions, if you are approaching that age or you're charitably inclined in any way, give us a call. We can handhold you through all of this.
Yeah, and yes, we are kind of weird because we would like to help our clients give their money away in addition to growing it.
Right.
So anyway, folks, we thank you for listening. Until next time, you've been listening to the Spend Life Well Show.